WPG Talk Radio 104.1.
Thank you very much. What an exciting first 2 hours it's been, and then there was Chuck Malamut. You should have saw his hands go up in the air. No, this is a great part of the program. I had to do it. We only tease the ones we love. This is Chuck Malamut's program every Tuesday in the 8 o'clock hour. It truly is an hour of the program that we've cherished for the past more than 25 years together. Chuck is the managing director. He leads his team, the Malamut Group, at Morgan Stanley's Northfield, New Jersey office. To reach Chuck and his group, 609-383-2010. And the program that you're about to listen to is presented by Chuck, who is a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. Chuck, Merry Christmas, Happy Holidays.
Harry, Merry Christmas to you, your family,
Thank you.
Your wide range of listeners. I just want to wish everybody the best for obviously a safe, productive holiday season, and it's gotta be careful out there. It's really, really, really rough. I mean, I won't go into a description at length. Let's just say we came out of Atlantic City Friday night after our team dinner, and I witnessed the most incredible thing where I'm almost convinced the vehicle was either stolen or was in a chase. Long story short, coming down the White Horse Pike, as you cross over the bridge, heading into Absecon, you collapse from 3 lanes to 2.
Yep.
And then I'm looking in my rearview mirror, and I know I'm in a right-hand lane, and I hear the rumble strips, and I see this vehicle.
He's coming on your right? He's
coming on my right. Has to be doing 80 miles an hour. Figures he's running out of real estate. I'm assuming she, the driver's running out of real estate, swerves into the right-hand lane that I'm in, clips the car in front of me, sideswipes that car, then moves into the left-hand lane and is literally bouncing off of the cement divider.
Wow.
And it was one of those instances where, Harry, it was
either some drunken fool or some kind of just deranged maniac.
Or whatever. I mean, it could be any of a number of things, but I can't imagine that someone would be that disrespectful to the vehicle that they were driving, other than the fact that maybe it wasn't their vehicle.
Yeah, I always leave open, too. You never know. Could be a medical situation. Somebody could have been having a heart attack or a seizure or, passed out or, but it doesn't sound right.
No. So anyway, I just want to make certain that everybody clearly understands how important it is to be a defensive driver. I mean, it's I don't want to sound like a commercial for the Bill Elliott campaign, but certainly what we witnessed last Friday night was nothing short of scary,
harrowing. Chuck, before we get into what I know is going to be an outstanding program because you're going to do your great market update, and it's our 2016 year in review program because it's hard to believe, Chuck, this is our last program. No, it's not our last program in 2016. We have one more, but it's one of our last, so it will be a year in review as well. I want to get your take as somebody that certainly, obviously at the highest level, you participated as a senior casino hotel executive, and you and your family had skin in the game a long time before the advent of casino gaming. Have you followed this piece of legislation that was just voted?
Harry,
this is crazy.
In my wildest dreams, other than having people that have absolutely no idea what it is to run a business, and the fact that they just want to, again, sort of pile on to in an effort to, take any credibility out of Atlantic City. I don't get it. I know that you spent a fair amount of time in the last hour, chatting about it, but Harry, I do understand it's a right. It's a privilege to have a casino gaming license, but what? I don't know why they're doing what they're doing. I mean, what is what is the? I mean, to get a license, you have to apply. You have to pay. You have to be investigated. It's not just like going to a lottery machine and getting a scratch off ticket. I mean, it takes a lot to get a license, and it's very, very expensive to get a license. So what was their when you think about it, it's sort of the talking points. Like, why did they in fact vote for this?
Here's what I think. I think on its face, because there are some good actors that I'm really surprised at. Like Berzicelli's a good guy. He's a friend of mine. He's a good guy. I just don't agree with this, and I think he's one of the key prime sponsors. Whalen, you expect him to sell out. I hate to say it, because I'd love to talk very well of him, but he makes it tough. He's not to be relied upon. You can't count on the guy. But I think on its face, they will say that it will keep people from putting thousands of people out of jobs because there will be implications to them, and that the punitive penalty of 5 years before you could be considered for a license, will keep any potential bad actor from doing something like that. The problem with that, though, is this was not – and then there are certain cases where there have been some bad actors that have done some things. The problem is, what about a very real example, Trump Taj Mahal? Under this law, that would mean – that Icon could not reopen Taj this January, February, or March, that he'd be locked out for 5 years. That doesn't make any sense.
Harry, look, and to make things worse, the other legislation that did not pass, unfortunately, it did not pass, with respect to the governor writing a book and getting paid. And I mean, it's sort of everything is going bad here. And you're looking and trying to understand – what's all the insanity up there? Are they drinking? Is there something in the water that they're drinking to make them, have this cause and effect with respect to where we are?
Here's the other piece of it. I think there is such a desire to bring casino gaming outside of Atlantic City that we're being sabotaged.
Harry, there's no doubt about it. I mean, even though the referendum failed by the widest margin for any time any referendum was presented from the beginning of time in the state of New Jersey, they'll come back.
80% of the people were called stupid, Chuck. How about that? 80%. I mean, sometimes there can be a fringe percentage that we're not well informed. 80% of the state was stupid.
Well, Harry, you think about how crazy this world is when I know that we're a little off track here, but you talk about the Electoral College and all the everybody. I mean, not everybody. By the way, a lot of people.
Did we call that right, or did we call that right?
I think it was 305 to
304.
304. Okay, to 221 or something.
She lost 5, so from 232 to 227. Okay. So 304 to 227. It was never in doubt. Ironically, they tried to make the case that Trump was going to lose all the unfaithful electors that were going to step up. 2 out of Texas did it. 5 on the other side, and more wanted to, but they wouldn't let them. So we are living in crazy times, but that's why I always say, Chuck, the people in this area, we have to stay very close to one another because we definitely have people that are working against us right now.
There's absolutely no doubt about it. I mean, you see, the most recent opening of the MGM down in outside of Washington. The ongoing construction of the casinos up in upstate New York. The pie gets cut thinner and thinner and thinner, and we have to do everything in an effort to retain our market share. No doubt about that.
So, Chuck, let me ask you a quick year in review on Atlantic City. What are your thoughts?
I think, Harry, that Atlantic City, you hit that. It's like anything else. You kind of hit the bottom, so to speak, and then you work your way higher from there. And I'm pretty convinced that's what we witnessed as we got into 2016.
And then, of course, we had for much of the year the cloud and the uncertainty, and where I think this really uniquely fits in with your program, Chuck, where you talk about, from the financial market standpoint, about how markets, they don't want uncertainty. They don't want instability. They want, they want to know that things are stable and so on. We had to operate in an environment where it was unknown for the entire year whether Atlantic City would lose its New Jersey state monopoly. That was terrible for anybody looking to do business in Atlantic City.
Well, and then Harry, on top of that, who was going to be responsible for running the city? Was it going to be the city onto itself, or was it going to be the state? So it took a long. I mean, everyone.
And even though that was always in doubt, it was never in doubt with me.
Of course, it was never in doubt. And look, I'm not taking a shot at the state of New Jersey. Don't get me wrong, because we all pay our taxes, we pay our fair share. But I'm still trying to figure out how a state that is ranked as low as it is versus their competitors, as far as budget deficits and not operating within the boundaries that they're supposed to operate in, and having a governor that his approval ratings are now in the teens, maybe teens, 20s. I mean, what makes Harry? Are you convinced that they're going to absolutely be able to, right the ship here?
No. Okay. No. I mean, look, if we look at how the state has been run, then there are some more competent people under the era of Chris Christie, in my view, than there has been in the past. But when you look at what the record of the state to run state affairs,
it's abysmal.
It's laughable to say that they would be the solution, to fix Atlantic City. But, that's the system that we live in. Chuck, when we come back, Chuck is going to share his market update. We're going to get into the 2016 year in review as we continue. We're at 17 minutes past the hour. This portion of Early in the Morning brought to us in part by the Harbor Pines Golf Club, owned by the legendary Gerwick's family. If you would, when you make an appointment at tea time, or you purchase a golf membership, or if you're coming to the wonderful, lavish New Year's Eve party on December 31st, beginning at 8 p.m., or any of the other things, weddings, any type of party, there's school functions. There's just so many different, not just permitted uses, but just practical uses to take full advantage of the Harbor Pines Golf Club, well beyond just the realm of whether you play golf or not. And certainly for golf outings with Deb Stevenson is the only certified golf planner in all of southern New Jersey. You're in great hands there as Harbor Pines becomes a very, very visible part of your next event. So even if you don't have experience, if you want to raise some money and you think that the staging of a charity golf tournament is that vehicle, even if you don't have the experience, sit down with Alan Greenman, sit down with Deb Stevenson in particular, and believe me, they will become a very, very big part of your event and make your event very special, important, and you'll be pleased. Harbor Pines Golf Club presents the 2016 New Year's Eve Party, Ring In 2017, on December 31st from 8 p.m. to 12:30 a.m. Lavish hors d'oeuvres, open bar, new and improved surf and turf dinner, plenty of dancing with the returning DJ, hats, noisemakers, and a midnight balloon drop, all for $89 per person. Harbor Pines Golf Club, owned by the legendary Gerwick's family at 500 St. Andrews Drive in Egg Harbor Township. Reservations are required. 609-927-0006, extension 23. They're on the World Wide Web at harborpines.com. And if you need any last-minute gift ideas, you can buy now for big savings. If you go to harborpines.com, click on the following links, and you'll be able to give the gift of golf this holiday season. You can click on the membership offerings. There are so many to choose from. No matter what your availability is, they can tailor a membership that will work great in your particular individual circumstance. You can purchase gift cards and other offerings at Harbor Pines Golf Club. Details at harborpines.com. Back with Chuck Malamut, our official financial advisor to the Early in the Morning program, in 60 seconds. Hey, thanks. Great one. With Chuck Malamut, our official financial advisor for all of your financial planning needs, turn to Chuck. 609-383-2010. Chuck, your market update.
So, Harry, if we take a look at last week, the market was pretty muted at best. Wow, excuse me, we got completely sidetracked here.
Sorry,
hello, ladies.
You.
That's okay.
Beautiful women came in the studio.
That's okay.
Giving
It's
me
great.
Presents.
Hey, nothing better than that, Harry.
Makes me happy.
All right, so let's try this all over again.
Okay,
all right,
sorry,
it is Christmas. It is the season. So anyway, as you take a look at last week, the market, it's basically at that point, Harry, we made such a big run after the election that we're now digesting. We're digesting those gains. I mean, the S&P was down 0.3%. The Dow was actually up almost 0.5%. All the other major indices were either slightly negative, slightly positive. I mean, what we're looking at now, Harry, is how bonds, fixed income, particularly governments, are trading. If you think about the move that was made from the end of July to where we are now, a huge move in the 10-year, and that has basically what the market is saying, and the bond market is usually more right than the stock market at times, is the fact that rising rates, potential inflation, extended job growth, higher GDP, and the Fed comes in, as expected, and puts their one rate hike in, with the comment that we're going to probably go, another maybe 2 or 3. But I think a lot of that is obviously data dependent. So, as we look at where we are, year to date, the S&P, almost 13%, the Dow Jones up 17, the Russell up over 20. Who would ever imagine, Harry, that when we got into the beginning of 2017, when we were looking at high single-digit, low double-digit returns. Basically, when we make that like 8, 10, 12 at best, and for the longest time we sat here and said there's absolutely no way that's going to happen.
But then something supernatural happened, Chuck. And
then it's a classic case in being on a long-term journey and not participating in a marathon and not a sprint.
Yes. Because
in all likelihood, if you think about the number of times where we had setbacks in excess of 5% over the last 2 years, and what's pretty amazing is the equity market has been rather resilient to all that. But
and by the way, I'm sort of stubborn on certain things and persistently stubborn on certain things. Had the so-called market experts that wanted to keep the status quo, there would not have been. Do we agree, Chuck? There would not have been this Trump bump, whatever you want to call it. If he didn't win, it wouldn't be a Trump bump because he didn't win.
The Trump. So we go from the. I like that, Harry.
Yeah,
so we go from the Trump train to the Trump bump.
Right. So without that, though, this is a different conversation.
I think for sure. I mean, if sitting back and sitting there and watching the S&P futures trade down 6, 7, or the Dow 6, 7, 800 points on the evening of the election, because again the expectations and a lot of that is vetted by the media, is the fact that we were looking at a Hillary Clinton president, and we talked about that. I mean, all our strategists were basically, predicting the same thing, and
they wanted it. The markets wanted it.
I think the market, yeah. Well, no. Here's what the markets like stability.
They didn't want uncertainty.
And the fact of the matter is, Harry, there is a lot of the markets were looking and saying we have a lot of instability potentially with Donald Trump becoming the president of the United States, and I think everyone had that thought process.
I know a self-made billionaire that that would be good for jobs and great for financial markets and great for banks and great for brokerage houses. Oh my God, this was a real dilemma. I don't understand how they could be so wrong.
I think, Harry, what happened, if you take a step back and look, the campaign that he ran was brilliant,
especially at the end.
And I think where a lot of people got very, very confused is they weren't certain exactly what he was going to say when he was going to say it. So,
I understand.
He was rather unpredictable.
Yes,
and still to this day is somewhat unpredictable, but certainly not.
But I'll tell you where I thought the markets should have been more mature. He's unpredictable and maybe unconventional more than unpredictable, and that's a distinction with a difference, Chuck. I don't think he ever would be unpredictable in terms of things. Well, then again, I know how big geopolitical issues can be towards our financial markets, so I don't want to be ignorant of something that you taught me a long time ago. So if I was going to split the baby and say that he's unpredictable in realms outside of markets, but that's not a fair statement.
No, Harry, I don't think that is a fair statement.
So I take it back. Before I said it, I take it back. Because if you do something undisciplined that could affect, the country, then it can affect markets, and that's where geopolitical things. But I do think, though, very quickly, and we've talked about this, Chuck, and as part of our 2016 year in review with you, we talked about how quickly his rhetoric became very consistent, very sobering, very positive, conciliatory. I mean, all the things when you're going to have change that you want to see and hear.
Oh, absolutely, Harry. So let's take a step back here. Some of the things we oftentimes look at anywhere from 7 to 10 different things that we think will happen in a particular year. So I'm going to probably get chastised for this because I did say it one time, and you beat me over the head with a bat. One of the predictions was GDP, and the fact that the prediction was that GDP would remain below 3%.
It did.
And nominal GDP below 5% for, believe it or not, 10 years in a row. 10 years in a row. And
hasn't it? I thought it was below 3 for 10 years.
Well, no, I'm saying we've been, so now it is for 10. We're now 10th consecutive year. So, as we got to the end of the year.
By the way, that's a first in American history.
Yeah, as we got to the end of the year, economic growth and inflation both picked up. As we got to the end of 2016, although as we think about and we witnessed and we lived through everything that transpired in the first half of the year, there was a lot of weakness in the economy. And so, one of the prediction, below 3 and below 5, that's certainly going to happen. Now,
halftime break, I want to just throw this out, then we can come back with plenty of time. Is it possible that if this whole Trump bump thing just electrifies the tail end of the fourth quarter, could the fourth quarter hit 3% and beyond?
I think it could, Harry.
I do too.
I think we're very, very close.
I do too. That would be amazing. And, of course, it would be on Obama's watch, but you'd have to put an asterisk because it wouldn't have been because of him. And I'm not being a wise guy on the Chuck Malamut show because we don't talk politics. I'm being truthful. This would have been in spite of him, and it would have been part of the next president's record just in terms of him with the standing as president-elect. But it would go on the calendar of the previous president. So that actually, if we got above 3, that would get a significant negative off of the resume of the 44th president, Chuck, because 3% for the fourth quarter looked no way, no how. But I agree with, I said it, and Chuck bought into it quickly. I think there's a chance, a good chance even, that we might see 3% GDP for the third quarter. And keep in mind, depending on who reports the numbers, there's creative ways to get there, too. Thanks very much. We are back with Chuck Malamut. Ladies and gentlemen, Chuck is the official, the exclusive financial advisor for the Hurley in the Morning program, Hurley in the Morning charity for that matter, Hurley in the Morning family. The Malamut Group at Morgan Stanley's Northfield, New Jersey office, 609-383-2010. For all of your financial planning needs, turn to Chuck and his group, the Malamut Group, 609-383-2010. Chuck, you were saying.
All right, so Harry, let's talk a little about interest rates and the Treasury bonds. So one of the things that we chatted about a year ago is that U.S. Treasuries would increase for a second year, and at the same time, high yield interest rates, so those spreads would fall, and that did in fact happen. If you look at high yield, Harry, those that own high yield had a very good year. The spread has dropped basically from 660 basis points to 405. So that's a big move. And if you think about a few months ago, we weren't really convinced that we would get that movement particularly in the 10-year. But as it turned out, from the time of the election, the 10-year rose basically from 2.27 to almost 2.6, and it's backed off a little bit. So that's where we are this year in 2016.
Chuck, before you get to the next item, and I know this is sort of chronologically not polite, but I think that our listeners would love to hear you address something. we are going to be, as it looks, unless Janet Yellen gets out of there anytime soon, early in the new year. We'll see what time will bring there. I also mentioned earlier in the program, Donald Trump, within 2 years, he has 2 openings right now on the Federal Reserve Board. Within 2 years, he will have appointed a majority of the Federal Reserve Board. It's going to be interesting. I think he'll also be able to name the chairman, but that's not my point. That's a little bit of just side story, backstory. Because for the first time in like a decade, Chuck, we're almost in a promised rate increase environment where the Fed is promising 3 rate increases in 2017. Now, to be fair, we thought we were in an environment like that. Then they didn't do it based on what happened. But if we are in a rate increase environment where we haven't been in a decade, what do you think our country, how do you think things will work? I mean, it's always been able to be done responsibly, but we haven't done it in so long. Are we ready to do it?
Harry, I think we are. And if you think about everything that's being proposed at this point in time, and a lot of people are obviously very concerned about, what the Fed's going to do, how they're going to do it, when they're going to do it, and obviously what they do is very, very data dependent. And you've talked about it, and we chatted about it a number of times. The fact the Fed could have made a move last summer, and opted not to, and not that they're political, but they certainly need to make a move in September, and they could have done that as well. So if you're worried about about these potential Fed rate hikes, I think, Harry, the tax cuts that Trump is proposing, that could basically, I think that can save the day. So think about this for a minute. If you get 100 basis points, or that's 1% increase in the mortgage rate, but you end up with a 5% cut in the personal tax rate, you end up doing more on a positive, significant level than you do damage because of the rate hike. So, Harry, the Fed met. They had their 2-day meeting in December. They increased rates by 1/4 point for the second time in a year. So, they were getting criticized or chastised for what was referred to as the annual rate hike. And, they projected 3 hikes instead of 2 next year. And that sort of rattled the market the day that Yellen spoke. The last time central banks raised rates, as we've identified, Harry, was back in 2015. And it was the first time that rates had increased in 9 years. And you think about what we talked about a few minutes ago, GDP below 3, nominal GDP below 5 for 10 consecutive years. So it does go hand in hand with these low interest rates. So the hike, Harry, was long overdue. It could have happened as early as last June. Either way, it really doesn't matter at this point in time. There's been so much focus on this 25 basis point movement at the front end of the yield curve. It was sort of a non-event. It was already built in. It was built into short-term rates. It was built into CDs. It was built into LIBOR. It was built into Treasuries. So when you think about it, Harry, it's not the short end of the curve that drives where funding takes place in the marketplace. It's actually at the back end, the longer dated maturities. That's where capital expenditures and where mortgage funding moves for the most part. Higher rates, Harry, historically tend to be a drag on the economy. This time, we think it might have an opposite effect. And that could in fact create a little more equilibrium today, which gives you and gives your listeners and gives the general public and gives corporations and institutions and hedge funds and private equity more confidence to invest. So, and again, to normalize, the Fed gives people a sense that we're not distorting interest rates. And I think you said it loud and clear in the summer and into the fall that you're basically pulling your hair out saying, well, Janet Yellen, you need to make a move here. And, and they just, stayed on course. Rates remain where they are. We're not political. Rates remain as they are. And then bang. And then we get the rate increase, which is obviously very, very well telegraphed. So we don't seem to think that the rate increase here is or the rate increase is going into next year. If we're able to get these tax cuts on the table, it's going to have a major impact on the economy. We think the economy is going to be in a lot better shape a year from now than where we were a year ago.
And then ultimately, Chuck, tell me, I'm the layperson, you're the expert on the panel, but people that have had no COLA increases because there's been no inflation or next to no inflation, with a rising interest rate environment, yields should come up and people should get better interest rates, even on passbook savings accounts and other yield instruments that generate profit that way, and things like Social Security COLAs and all that. We should actually see, quote unquote, sort of normal operating procedures.
Yeah, normal CPI, normal GDP, and I think that we were told for years that this is the new norm. The new norm, something south of 2%. So the new norm is going to be the real norm, and to grow the economy. Because if businesses are confident, they're not going to necessarily, increase their stock buyback program, but they'd be more inclined to use that capital, to grow their business. And that's, you think about it, it's that 51st person, right, with the small businesses, with Obamacare. Hopefully that gets reworked.
Yeah, make that not a penalty, and then you'll see it happen.
Yeah, so one of the things we talked about for a long time, the government's your best friend. They're in your front pocket with you, and and there's nothing wrong with government. Government is a necessary part of our existence, but it plays a specific role, and they need to kind of take a step back and let Trump and his advisors begin to shape where this country is going. And we're going to have, in a relatively short period of time, a clear understanding as to whether or not what he's doing is correct or not correct.
Here's one thing I'm willing to say, Chuck. There can always be a first, but whether it was President Kennedy in the 60s, early 60s, President Reagan in the early 80s, and I'm sure there are examples before those two presidents, whenever we lower the tax rates and taxes in general for corporations and for citizens, we usually see incredible periods of great growth.
Harry, I think that's the expectation. You think about the fact that the moves that the equity markets, particularly domestic versus international, have made over the last 4, 5, 6 weeks has been nothing short of remarkable. I mean, we are right now in what I'll call a quiet period where companies, because earnings come relatively soon, they can't really say much, and at the same time, we're digesting the gains that were put in. You're going to get some pullback. We had a day last week when the Fed made their announcement, but in the fact that the expectation was 2 hikes and not potentially 3. But that's subject to change as well.
Yeah, I get more excited about certain mile markers than you do because,
Dow 20, it seems like,
it was so tantalizingly close. I remember saying we are one great day or 2 good days away from hitting it. We got the one good day, and the next day it just didn't happen.
Well, we're gonna get there before the end of the year, Harry. I'm pretty confident that's going to happen.
What do you think the 20,000 threshold? What does it mean?
It's a number, Harry.
But it is different than 19,000.
It is 19. It is different than 18, 19, 20, 21. I mean, 20 is a big number because it's a round off.
Is it hard to believe in your career that it's like probably more than 18,000 points higher than when you started?
Harry, I think the one thing you have to recognize about the Dow more so than the S&P 500, the Dow is 30 stocks market weighted. And when they take a stock out of the Dow and they replace it with another stock, and they do that, they do the arithmetic calculations, is it really what has happened? I mean, did you take out a company that's just been an awful performer and you put in another one that like years ago, like a Microsoft, for instance? So you have to be a little leery of the number per se. I mean, and we have become so accustomed to the Dow.
And is that because that's just so controlled? It's so specially tailored and everything like that?
Yeah, I think you really need to take a look. And for the life of me, Harry, I can't.
But you know
I
that
can't quite figure out. Yeah,
perception versus reality equals substance.
The one thing that I've liked to have seen in the 30-plus years of being in this business is that there's more attention drawn to the S&P 500 than the Dow. But I think we have just been so accustomed to and ingrained about the Dow Jones Industrial Average. Well, think about Dow Jones Industrial Average. Is a tech company really an industrial? And should it be part of the Dow? I mean, the Dow is always – I mean, the index is always ever moving, and it needs to be consistent. It needs to be current. But I think the true test of time is the measurement of the S&P 500 because it's 500 companies market capitalization weighted and not just 30.
Gotcha. Closing sort of little bonus.
So here's where we are. We talked about 10 items last year. We only covered, believe it or not, Harry, 2.
I know.
So I'm going to reserve the next week to chat about the next date. It should be a relatively quiet week as we get into Christmas. As you get to Friday, a lot of people are not focused on the markets. I will tell you that we are spending an inordinate amount of time on tax planning. We're down to the wire, and if you have the ability to offset, gains versus losses or vice versa, you need to do it now because come April, you're going to be writing a nice check to the government over something you might not have necessarily had to do. So please take a look at what you own, not just equities, but take a look at the mutual funds that you have that potentially paid out or have paid out or will pay out capital gain distributions, long-term, short-term, and ordinary income. ETFs, exchange-traded funds, Harry, typically don't have capital gain distributions to concern yourself with, but you still have time. And don't be complacent, and because if you do, at the end of the day, Harry, you're going to be writing a check to the government you shouldn't have to write.
Great advice, Chuck.
Harry, again, look, Merry Christmas to you.
Thank you.
Your family.
Thank you.
All of your listeners, have fun, be safe, and we will see you. We'll see you next Tuesday.
By the way, a great friend of the program who you know because you came in the building with him, but he remains anonymous, just wrote me, so do charity now. Another text popped over. He said it better English than that. He says, so do your charity now, and he just did it.
He did, yes, absolutely.
I took his gracious offerings and said to him, "Whoa, look, I made my hands fall down to the ground because that was heavy. That was heavy checks."
And you were smiling ear to ear.
Yes, I was.
No doubt about that.
Thank you, Chuck.
All right, Harry, great holiday. We'll see you soon.
Same to you, sir. Chuck Malamut, the program you just listened to presented by Chuck. In my view, the best in the business. Chuck is a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. When we come back, because I know we have taken a lot of calls today in the first 2 hours. We dropped a lot of calls we just physically couldn't get to. If you want to jump in, we have some open forum right now. We'll have about 9 minutes uninterrupted next. 609-407-1450. Phone lines are open if you want to jump in. Chuck, you good?
We're good, Harry.
Okay, my man. We'll be right back. Don't go away.